Good morning, everyone. My name is Josip Kasik. Welcome to Options with Options. Today is April 15. Just want to confirm the sound. If you can type in the chat box that you hear me. Good morning, Christian. Good morning, JB. So we are not financial advisors. We we do not provide financial advice. Please take a moment to read these disclaimers, even if you need to stop them. However, if you need to get in touch with me, I have provided the email right here, josip@tradewithufos.com. And you can also go to ask the questions on our website, tradingwithufos.com. I'm going to bring that page right here so you can see it. And this is where you can uh, book the meeting with me, one-on-one coaching. You can look at the live session notes. In fact, I will go over this particular trade in a bit. And here, down here, we have an area where we are encouraging our clients to post the questions, and anybody in community can answer it, or instructors can answer it. So there are a lot of interesting questions here about how to roll the calendar, what is a different thing, like in terms of the options and things like that. So today's agenda is going to be focused mainly on a big picture, on a current environment big picture, and then I'm going to review my last out-the-money trade, and I'm going to finish up with psychology. And I'm very excited to be able to finish up with psychology because for the last few session market was open. I was trying to place the 2 or 3 trades within an hour, and I haven't had a chance to talk to you about psychology. Oh, great. Good to see you, Mark. Good to see you, Joe. Good to see you, Jeff. Thank you very much, Christian, for confirming that sound is good. So without uh, any delay, what I would like to do right now, I would focus on big picture, and I usually just go maybe 10 minutes to talk about what the market is doing in relationship to the what the market has done. So I'm going to start with Dow Jones, and I know we're only in the middle of the April, and this particular bar that we are looking right here is not yet formed, but it's obviously within a range of the previous bar. So right now on a monthly, it would be very, very difficult to make any decision because there's a lot of indecision taking place. However, that doesn't mean that all the markets are looking like a Dow. Obviously, S&P is looking very much like it, right? Russell is looking very much like it. But when you come to the weakest of these markets, we have actually closed pretty much at the low of this particular bar, that it's not completely formed, which means there is a quite potential for the technology sector to go even lower, right? So when it comes down to our evaluation, this is pretty much what I'm going to do about the monthly, because first of all, we're not yet done with everything that concerns this particular month. But what is interesting to see over here on Dow Jones, we have a little wick. On a Russell, we have a little wick. But then when you're looking at the QQQ, we don't have a wick. Well, we also don't have a wick on a SPY. But when I now switch back to the daily and I evaluate the daily SPY, we're going to be able, of course, I'm going to use the options with options because this is the one that everybody in the community is most familiar with. You're going to feel that we haven't done much of anything for the last 4 sessions. I'm going to also switch this to the daily, and I'm going to just show you these last 4 sessions that we have done represent the 1 month. So they represent the 1 month, and we have had 2 down days. Then on Wednesday, we ripped to the upside just to confuse everybody. And then yesterday, we came down pretty much with the vengeance and we took everything back. So what is that actually telling us in terms of the current environment? Well, if we start from the top to the bottom and just kind of watch where the price action is in relationship to the 9-day exponential moving average. We are currently below it. In fact, for the last 7 sessions, right here, for the last 7 sessions, we've been under the 9-day exponential moving average. And according to the standard deviation over here that I'm showing to you, we are just about ready to turn. Now, I know if you watch the financial media, they're almost like a betting that it's for sure it's going to go lower with the war in Ukraine and all the hyperinflation and everything like that. But sometimes the market needs to rally before it breaks, which is a kind of statement that a lot of professional traders have used in the past. And I would not be surprised if all of a sudden market fools everybody, because when you're looking right here, the situation that I'm trying to show you is that we have a situation that for a 7 sessions, we've been down, and statistically, for about 3 sessions, we might actually rip. So what usually happens, and this is going to be also emphasized, once when I talk about the trade psychology, that market tends to do something that least amount of people expect. So when we close at the low, everybody's expecting, oh, it's not the brainer, like a market is going to go lower. I would not be surprised if all of a sudden we actually have a rip to the upside. And when we have a rip to the upside, not too many people are ready. And then you have a phenomenon that is called short covering. And that's pretty much what happened on Wednesday, that a lot of people had to short cover because they got overly bearish. So it's important for us also to look at the implied volatility. And I'm showing you now this area right now where the implied volatility is. And if there was a lot of put activity, then you would actually know that, like, okay, the big institutions, the money managers, the hedge fund, they're actually short. But when you still have a calls above the puts, activity of the calls being traded above the puts, that means there is this possibility that our climate can change to the upside and that we can go higher. So having said that, I'm going to now end my discussion about the big picture, and I'm going to review one of the last trades that I did. And that trade was done on April 5th, and I'm going to highly encourage all of you to visit this website, tradingwithufos.com/Josip, and to go down on this particular trade. So this particular trade was done on Tuesday, April 5th. The market sold off hard when we did the session, but then by the end of the day, it went even lower. So just to refresh your memory of what is happening here, I'm going to pull up the IWM. I'm having here the indication that this is exactly the April 5th that we were looking at. And we had that session early in the morning, which means the market was around 205. By the end of the day, we went lower. And for the remainder of all these other days, the price action has gone lower. Therefore, what I was advocating at that session, although at the time, it still seemed that the market was somewhat bullish, because we were creating then higher lows, and over here when we had that session, we still were in an uptrend. Of course, vision is 2020 afterwards, but at the time I was making a bearish bet. There wasn't a red UFO above us, and I was saying I'm gonna place one of the most bearish strategy that I can possibly place, and that is I'm gonna buy the bear put. And not only I'm going to buy that bear put, but I'm going to have a bear call finance that bear put. So when I bring up here this recap of that thing, you can actually click here and observe what I did here. I bought the 206 call, and I used that money. I used the long call to have a hedge so I can sell the 205 call, which would be turning me into the bear call spread. At the time, 205 call that I was selling was only 37 cents in the money. Only 37 cents in the money. And what is interesting to observe that 37 cents that was in the money was intrinsically worth. So when you have that kind of situation, then you're saying like, well, you're really trading at the money option with the 206 call being out of the money. And then what I decided to do to use the credit that I had received and to go ahead and purchase the 206 put and to instantly sell 205 put. So on the chart, really everything comes down to the one single line. And that one single line is kind of easy to explain, that you can have as much technical analysis done as you want, but as long as the price action on an expiration is not above the 205, then bear call spread expires worthless, and that bear put that you buy expires in the money. In the money. So what I'm doing right now, I'm actually bringing up here the snapshot of what this thing is looking this morning. So again, this is agenda that I mentioned to you that I'm going to go over it. I looked at the current environment. I'm reviewing my last at the money trade, and this money at the money trade involved the IWM that at my entry was trading at 205.37. We also did the Nvidia and Twitter, but then I checked my account. Although I placed the trades, I never got filled. Now, Mark, I know you got filled on the Twitter. I can address that in a moment if you type in the chat box if you have gotten filled in the Twitter, and then we can evaluate how well that trade is working for you. But over here, what I want to show you right now, that my 205 call that was at the time 37 cents in the money is currently only 4 cents in the money, while the 206 call that I purchased for $2.85. So this financing of the selling of the bear call spread right here, you can see 205 call. 205 call that I have gave me a credit of the $3.38, but 206 call that gave me an ability to be able to sell that was a 285. So I have gotten the difference of those two. So what is happening with 206 call right now? Right now it's worth only 3 cents, and this is worth only 4 cents, which means that bear call spread, while we are down here on IWM on 198, it's completely worthless. Zero. It's worth nada. There's no value in it. But it wasn't the bear call spread that was making me money. It was my debit spread that it's called bear put spread that was my directional trade, because I needed my put spread that I have paid for. I'm going to change the color here into red so it can be emphasized that I'm now talking about the bear put spread involve these strike prices. And these strike prices that are being involved in the bear put spread are 206 and 205. So 206 is bought, which means I want a price to go down. And 205 was very conservative at the time when I placed that trade on April 5th, was like, I just don't want this to go above the 205. And now when you're looking at the chart, you're observing that we are currently, if we are looking current price at 1908. So that's mean that my whole trade involving the bear call and bear put is at the maximum profit. It's at the maximum profit. So the one that is a 206 is the one that we bought, and that right now it's worth $7 and I have paid for it $3.51. I wish that I didn't pick the 205, that I had picked something lower, because right now the 205 is also in the money, and I'm talking about the puts, and that's why I'm using the red, because for the calls I use the blue, but over here I'm using put. I have sold it at 307, and right now it costs 601. So when you're looking at this, like, well, you shot yourself in the foot, like you should have picked something that is lower. But this is the thing. I have received the credit, and the amount of credit I have received on bear call, I went ahead and I have purchased the bear put spread. So that trade at the time was showing that the most that I could make at the time. And let me just bring this here so you can see it, that on a thing was making me amount of $100. If this thing would close right now, which I would need to close manually only one of them, and I'm going to ask you this question: which one would I need to close? So Jeff is saying, like, what about in the money put spread I need to close? I can't let it expire. This is not cash settle. I prefer to trade the cash settle instruments such as RUT. Maybe in the next session that I'm doing on Tuesday, I can place the trade on a RUT and then do nothing, because then it would be cash settle. But because it's IWM, I would need to probably exit this, and I would probably need to exit this for $97 of the profit, while my bear call spread, I don't need to do anything with it, because it would completely expire, worthless, because obviously we're now sitting at the 198.96. So Jeff says, in the money put, do you let it expire? No, Jeff. I only would need to close my put spread. So let me now go into that particular trade, so you would see it where that thing is. Let me just go over here, account statements, open options. So here's this. If I click here, type, it's gonna line up everything accordingly. So I would need to go down. This is my put spread. This is where it shows that I sold it at 307. I shot myself in the foot. Now it's at 6. But good thing is that my 206 that I bought for 351 is now worth $7. So I would highlight these things. I would single right click. I would create the closing order. And right now it says you will probably get the credit of the 98. So I'm going to now change this, not to day order, but to actually time enforce good till cancel, because obviously the market on Good Friday is closed, but on Monday morning, because this is expiring on April 18, which is on Monday, I'm going to confirm it, and it's going to be saying here 98 cents. Okay, 98 cents. Break even point is right here, but we are currently all the way down at 198. So we are good. So right now I have this working order right here to close this at 98. So when you're looking at this, you're actually realizing that the bear put spread was a conservative. I could have anticipated more, but taking into account when we placed that trade, that this bar was up here. It was at 205.37. We did not have this in existence, because at the time everything looked as if the market still wants to go higher, because we had this low and a higher low, and over here we had another higher low, which means at the time we were betting that this thing is going to pull back, but it has since then pulled back even more. So what I would like to do right now, I would like to now go back to the QQQ and consider another at the money on the QQQ. And the reason why I want to do on the QQQ is very simple, that when we looked at earlier examples, the QQQ looked the weakest. So how would I do this? Well, let's assume that we're gonna go lower a little bit, but I mean lower 338. That's it. That's all that I want. So that's mean it's a 338 and 48. I have a question here. Love this trade. Have a similar now on the QQQ with $2 spread, 2 units involved. Christian, why don't you do me a favor? If you have it right now, why don't you just give me the bottom line? And what I mean the bottom line is one single piece of information that I need. And that one single piece of information that I need is just one line on the chart. So when you're looking right here on this particular trade, the one line for me was a 205. 205. Christian, if you can tell me on your QQQ trade, what was your line on a sand? Because obviously on IWM at the time when I did this trade, which was this bar right here, on this bar right here, I only drew the line like this and say, you know what, I don't care how low this thing goes as long as it doesn't go above the 205. So Christian, if you could type me on a QQQ, where's your line in the sand? And I really mean line in the sand. You know, when is the real invasion taking place? Well, I live in Santa Ana, which is in Orange County, California. Let's say if the Canada attacks, which it's not going to happen in a lifetime. So from a Vancouver to come down, where in a Seattle, that would be considered invasion. From a southern side, from a Tijuana, they cross. Mexicans cross into Mexican troops crossed into San Diego. That would be called invasion. So you have a line in the sand. We said when this line crosses, something needs to happen. So Christian, you're looking this up. You know, I was saying over here, if I want something conservative, you know, I was more like considering the simple line being pulled up at 338. Now, if you're on a little lower, that's fine, you know, but I can build this around that whole thing just looking at it, and I would go into the options and quickly do it. So if I'm here on a QQQ, I will have a lot of choices to choose from, right? So let's say I want to place this as a one-day trade as soon as it opens on the Monday, right? 338 right now, it's completely out of the money on a call side. It's completely out of the money on a call side. I don't know why this says, because they widened the bid and ask. They have widened the bid and ask. In reality, intrinsically, if I believe that 338.43 is accurate price, if this price right here is accurate price, then the 338 should have an intrinsic value of the 43 cents. But what did they do here? They actually have made, and I'm going to change this color, let's say, into green so I don't confuse anybody. They change that the last price is 337.91, which would make my 337 call 91 cents in the money. 91 cents in the money. You have picked a 344 line in the sand. Okay, you know what? Let me stick to 337. You know, like, and I'll then revisit what you did there on a 344 level. But if I were about to do this right now using the 337 as a line in the sand, all that I would need to emphasize to you that I would then anticipate, I'm going to use a red line here, that by Monday we are going to be at 337. So 337. So how would I do this trade? Well, there's two steps to it. One of the sessions that I did, I think it was you, Christian, who mentioned, could you do it on the call side? I understand the call side better than on the put side. That's fine. For me, I'm first thinking about the puts because it's a bearish trade. I want this thing to go lower, but because you said in one of the chat texts to me that you understand it better on the call side, I'll do it on the call side. So I would sell 337 bear call, buying the higher one, which is a 338. Okay, now I know this is still set up on the thin, so you know, like I can just hit this little button here and I can actually change this in a moment, right? But what the bottom line is that I want to point out to you, what is my financing? My financing right now is going to bring in the 60 cents credit. 66 credit. So if I have a 66 credit, I need to see how much my 338, 337 is going to cost. This is what we need to do. This is what we need to do. So what I'm going to do right now to kind of not lose attendees here, I'm going to create here a table in which I'm going to explain. Today is the lesson day, obviously, because market is closed, that I have a bear call spread, and I have also a bear put spread. So my bear call spread, it involves buying to open. Of course, you need to buy higher strike price, okay? And you will be then also selling the lower strike price. So you're selling to open. Obviously, as Albert Einstein said, everything exists relative to something else. You can only do that when you have two things here. So if I know that over here, the currently, and we need to assume that this is at the 337.91. So QQQ, 337.91, and I like to highlight that because it's so much easier for me later on when I'm evaluating these trades that I know where the price was. So if I'm selling that 337 call that is at the money according to what the platform is showing to me right now, 91 cents. Christian, are you following this? The reason why this is 91 cents at the money is because the current price is 337. So if I'm now buying, this is the one that I'm buying, 338, and of course that's a call, then that would be out of the money. And over here, what we are showing here, that the value of the 338 is 0. 338 is 0. So now go on the chain, make this very, very simple. So here I am in the Qs. I'm going to select the expiration, that is Monday, soon as we open. And then when I go over here to the select the strike prices, I want a least amount of confusion. So I'm selecting a 337 and a 338. These are the ones that I'm selecting. So obviously they are being highlighted right here. And then when I go over here where it says a bearish bet, I'm selecting the bear call spread. So this is a bear call spread. So I'm going to edit this particular spread, and I'm going to make sure that I pick what I said I'm going to pick. That would be the 1 day. So you would know by the end of the day whether you're right and whether you're wrong. Only thing that I need to change here is I want a dollar spread. Dollar spread. So when I was learning this, I did not use the 50-cent spread. I was always using the round numbers. 337 and 338 is what I'm using right now. So 337, 338. If I now click OK, this thing is going to price it for me. And right now it's pricing it at the 60 cents. Just to make this a little bit more clear, because I understand over here that a lot of numbers and a lot of people get confused because there's just so much information to glean on. But if I cut this right here, it's very, very clear that we're really looking only at the 60 cents information. So this is a bear call piece, right? 337 is being sold. Bought is 338. I'm sorry, over here I'm flipping it because I always think from a higher to the lower, right? From a higher to the lower. And it says if you get filled, you get about 60 cents. So now if I know that I have this credit of the 60 cents, I want to invest in bear put. And only condition that I have that this debit, this is my only condition. Again, you can do anything you want when you trade. Oh, you're welcome, Christian. That's why I put these notes so you can go there and look at it. And if you're confused, you send me an email or you ask a question in that question area, and then we can figure this thing out. But I want to do this with the shortest possible trades. So by the time we meet on Tuesday, you would know whether or not this trade worked out. You would know whether it worked out. So now notice, I'm doing the same thing on the bear put, Okay, so bear put is really the one that you don't have ability to fix. Bear call, you do have ability to fix if you're wrong. And the reason why I say you have ability to fix if you're wrong, because what about if the market rips to the upside? You are long a call, then what's there to swear about? There's nothing there to swear about. There's nothing there for you to be angry at because you have a long call. Only thing that you need to exit at that point is what? 337 if the price goes up, correct? With the bear put spread, the situation is different because take a look. I'm buying the higher strike price. That is a 338, and here's a hint. It's a letter P, which means it's a put. If the price goes up, there's nothing you can do to fix this. You had the car insurance, you didn't crash the car. What happened to the premium? Loss. Had you known, you wouldn't have bought it. Now think about it. That wasn't your car, that was a rented car. But you had to buy the insurance just to have a peace of mind and to be hedged. And what are we doing over here? We are putting the target, okay? Our target is 337. And again, it's a what? Put. Oh, Josip, you should pick a lower one. No, I was saying earlier, I would not be surprised if the market ends up going way higher. But before it goes down, it might, before it goes up, before it goes down, it might go opposite way. So I'm placing this situation that I want to make sure that my debit is no more than a credit that I receive of the 60 cents. I hope that's now clear. So what I'm going to do right now, I'm going to tuck this away and I'm going to just alter a little bit this spread that I have. And the way how I'm going to alter it, I know over here it says a bear call, but look what is going to happen right now. I'm going to change this to the put and I'm going to change this to the put. And at this point, when I click OK, the name of the strategy changes. And why would the name of the strategy change? For a simple reason, the name of the strategy changes because we are not using the calls. We are using the puts. Now, look, this is the one thing that I did not explain in my last session, and I'm going to come back over here and I'm going to explain it now. And the reason why I'm going to explain it now, because okay, let's tuck this away. I'm going to put it up here because we already addressed the bear call. So if you address the bear call, you don't need to look at the bear call anymore. You know we got the 60 cents from it. Only thing that you need to focus on, what are we getting on the bear put? So I'm buying the higher strike price, which is 338, and I'm selling the lower strike price, which is 337 put. And you're saying, you're actually getting debit of what? Okay, let's round it up to 40 cents because I know this is now pricing it. But what I want you to recognize here, you can price the options in your head. You seriously could. If my bear call is giving me credit of the 60 cents, then my bear put should be 40 cents. And I'm saying it should be 40 cents because that's under the condition that the spread width is $1. I hope you get the math because it's very simple. It's very simple. So in this case, when I do my at the money, what really is going to happen, okay, I shouldn't do that because now it's forcing me to the different area. I'll just type it right here so you would kind of understand it. That my sold at the money call spread that is giving me 60 cents and then bought at the money put spread that is giving me 40 cents, they net me the credit of the difference of the two, which is a 20 cents. Therefore, my risk of the trade, of this trade, it's $1. And why is it $1? Because $1 is the spread minus the 20 cents credit received So the most that I can lose in this trade is 80 cents or $80. This is all it is. So if this trade works out the way how this top trade worked out, then that's a beautiful thing. That's a beautiful thing. That's mean on 80 on a $80 risk, I have ended up making the maximum profit, right? Making the maximum profit. So let's now do this thing in such a way that we execute, and how are we going to execute this? Well, we're going to execute this by using the thinkorswim. Now, of course, be aware of it. If I'm executing this on a thinkorswim, most likely, well, not most likely, certainly, I will not be filled. And why do I say that I won't be filled? For a simple reason, I won't be filled because the market is currently closed. And if the market is closed, then I will not be filled, right? So I'm bringing here thinkorswim, and what I'm going to do is I'm going to now point out to you that this particular side, which is a put side, and for a put side, I like to use a red, so I don't confuse anybody, because I'm talking now about the puts. So 91 cents, right? 337.91. When it gets subtracted from the 338, means that intrinsically speaking, this contract is at the money by only 9 cents. But I would like this to be at the money at the expiration a whole dollar. That means I want a price not to stay at 338, not to stay at 337.98, but to go lower. Okay. Meanwhile, my 337 that I'm going to be selling is completely out of the money. And I say completely out of the money because right now, intrinsically speaking, it's worth nothing. Now, of course, you can have a variation of this to many different ways, right? But my one thing in teaching this to you is really that you, as a trader, should decide on your own that you would like to just stick to whatever the bear call strike prices were. That's what your bear put should be as well. So I'm now pointing out to you here, and I'm going to make sure that I type this so later on when I put this, that this was at the money by only 9 cents. This 337, it's completely out of the money. Why? Because it's lower where the current price is. And where is the current price? Is at this particular level, right? It's at this particular level. So I'm going to just make sure that I save this. So later on when I do this, it's going to make perfect sense to you. Any questions right now? Yeah. Mark said the top and thinkorswim, they are showing a little bit different thing. I still want to actually go through the trading psychology, so I'm giving myself a little bit of time here to actually talk about the trading psychology besides executing this. So there's a couple of ways how you can execute this. I can keep this thing simple and execute piece by piece in such a way that that I execute the bear call, get the $60, and then execute the bear put. That's a viable solution, right? Like we can definitely do that, or I can try to do them at the very, very same time. And if I try to do them at the same time, then I can actually get even better fill. So I don't know which one would you prefer me to do it. Like maybe I can do one at a time and the other at a time. That's completely fine. I'll now follow the steps the way I do it. I single right click. I go where it says a sell a vertical. I need to adjust down to the contract size that I want, which is obviously 1. Now I'm tucking this away. So I'm tucking this away, and now I'm selecting this one. So when I select this one, I'm clicking buying the vertical. So I'm now buying the vertical. Make sure that you proofread this, everything that is going on, because this is now a different contract side. I'm going to be now adjusting this. And again, I personally prefer to do this because I like clicking. When my daughter was smaller, she would hear me clicking, and then my daughter would conclude, my father is working very, very hard, all this clicking. Because, of course, this day and age, teenagers, they can do in a few clicks. Now, over here, it's going to show you 20 cents credit. Now, I'm going to change this time in force to be good to cancel because that is a Monday trade. So when I go over here to confirm, if I now added this just for 1 penny, so we don't need to break our mind with the calculation. My maximum loss is $80. Okay. My maximum profit, I'm already taking $200 in. I mean $20 in. I'm sorry, $20 in. And if my bear put spread working, I'm making $1. So I'm making the profit of the 120 on an investment of 80. Of course, I will put the stop loss once when I get filled, right? But as of now, I'm sending that trade in. When I send this trade in, right away from my account, they're going to take the $100. They're taking that $100 because of the bear call, not because of the bear put, because bear put is my debit spread. So I'm going to leave it on that, and I'm going to, yes, Christian, that is really called not only double vertical, it's a double bearish vertical, because what we are using here are 2 type of things, right? We are using, and I'm going to edit the spread again because I want to add original bear call spread to it. So I'm adding one leg and I'm adding another leg. They're all at the same expiry. I'm building again selling, and we're selling the 337, and of course that's supposed to be a call. So when I now click OK, this thing calculates it at 21 cents. And that's what the current calculation is. So of course, I tweaked that by a penny, but you know what? I'm going to take whatever this thing is. So when I now print the screen, you will notice the platform itself calls it unknown. On a Thinkorswim, it will be called combo. That's what we call it. Will be called combo. I'm just saving this later on when I upload the things, then you have it. And I know one of you were asking me last time, could you give me also a risk graph? Ask and it shall be given. It's right here. Here's the risk graph. And I'm going to take a snapshot of this because for me, this is way more important than actual risk graph. So when I take a snapshot of this, and as I said, today is a lesson day, so I'm going to talk about the psychology here in a moment. I just want to finish this trade. And I'm going to also take a picture of this, and then I could talk a little bit about psychology, because many times people place the trade and then they get emotional and they exit, and then later on it achieves a maximum profit. That's actually one of the reasons why I switched to trading only cash secure options. Because the cash secure options, I don't need to have that fear, a broker is going to go in 10 minutes before the bell and going to exit me on an unfavorable price. That could happen on IWM, but that definitely should not be happening if you're trading the cash secure put, such as RUT or some of this. Okay, so I'm now done with this. We have about 15 minutes left, and I have prepared my notes so I can talk to you a little bit about the trading psychology. So if you don't have any question, yes, Christian, this is almost like a day trade. It would be better if you place this on Friday at the close, because then even if you exit on on Monday, because this expiration is Monday, April 18, you wouldn't be dinged as a day trader. Now, you could place within a 5 business day three trades, but be aware of it, then you would need to be sitting on your hands, right? So let's talk about trading psychology. That concerns the option trading. As you had noticed, option has a time component. So we're not trading only the vertical price. That's what the stock traders do. They buy and they hold for a long period of time. Option traders, they trade that axis that is time. So the key thing is the time. So when it comes to the losses need to be kept small because the small losses are easier to recover than the big losses. So when a trader accumulates the big losses, obviously it's going to take a longer period of time, and during that time, the trader might suffer from discouragement. Okay, it might have again another losing trade that is adding more to the already existing losses, and that's the point when a trader wants to quit. So it's really important to have a right mindset and to know that it's overall P&L what really matters. So the winning trades do not lead to quitting, and that's why it's important for you to be conservative with some of these trades. We don't expect to hit the home run. It's better for us to have these conservative trades that over the period of time add up, and we can even take a trading break, you know. But if you have these losing trades, the losing trades can really, really damage you psychologically. So be aware of it when getting out. The market orders are being hit, okay? And we don't have this luxury that we are exiting at the limit order. We need to put the market on. So be aware of it that what was happening on Tuesday on this rally up over here, on this huge rally up, the short traders were expecting the price to go lower. And obviously, on that day, price did not go lower. Candle is blue. It has gone higher. And they were hitting the market order. So sale order make the smart market go down faster. So when a stock market moves, you should be on the board of the order flow, you know, and you should have some unused capital ready to deploy so you would actually be on the right side of the order flow. So stock market moves and makes the moves that are beyond anyone's imagination. So I was saying to you, I'm now anticipating that we are going to close below 337, right? In case I'm wrong, I would have a loss, but this loss that I have, it's only $80 loss that otherwise can be $100 loss because I have gotten paid $20 for that credit. That small loss can be easily recovered if I did not have a big position. If I didn't have a position. So be aware of it that sometimes the trading is very, very boring, especially when the market is not doing anything, right? But we are in the business of preparation, right? Preparation versus a prediction, right? So a lot of people are predicting market can go up, market can go down, but we need to be prepared. So trader needs to be both prepared and focused, okay? And then when you're prepared and focused, then you're responding to the price action with the preparation that is already done. So you're responding to the price action with the preparation that is already done. So our reaction is very much different, right? And I have gotten introduced to the the community when I did one of the webinars, and you can search that on YouTube, and I talked about the concept of osmosis. And what that really means that less is better than more. Okay? If you're doing the one particular strategy on, let's say, a set of four products, such as I'm looking always, um, the four products such as IWM, the QQQ, the S&P, and the Dow Jones. Now, of course, the Dow Jones is only 30 stocks, and if I need to do it, then I don't do it with the cash secure Dow Jones. I just do it with the diamonds, right? But I would say I very seldom do the Dow. Most of the time, I'm trading the NASDAQ, Russell, or S&P. Now, S&P is my favorite because I do it with the cash secure, and the liquidity is just it's wonderful. It's a wonderful liquidity. So me showing you these four markets, the Dow 30, NASDAQ 100, S&P 500, and the Russell 2000, it's a broad market analysis, right? And knowing the price behavior is one of the easiest thing to assess. However, the second thing, risk management is so much more difficult because everyone's account is a little bit different, right? Now, the third thing, trading psychology, that's actually more difficult than doing the technical analysis or the risk management. So professionals are able to easily adapt to the changing stock environment. So looking only at the daily chart, really, it doesn't give you the whole pictures. We need to look at the multiple time frame. And again, when I'm looking at this thing in relationship, what is going on currently with the market, you're noticing I'm looking at the monthly. I'm looking at the monthly. So if my losses are kept short, as a small in terms of everything what is going on, then I can easily adjust when all of a sudden the market start taking out these red lines that are February 24th low. If all four of these major markets take out their respective lows of the February 24th, you better have some gunpowder dry and ready to commit yourself to the short side and to start doing this particular trade that I'm teaching you. What is happening right now is just a bunch of chop, and that's why the Jose is focusing on iron condors and on different strategies, double diagonals. But boy, when this thing goes down, that's the time that you actually start employing your capital and doing the things in a way how I have pointed out to you. So looking at the weekly, monthly, these multiple time frames, it provides you the better point of view. So main point is to have a bigger time frame because a bigger time frame always wins over the smaller time frame. So viewing and observing the many things at the same time is really very essential for a trader. And I know we have here ability to utilize the auto climate. We have ability here to utilize what is the reading of the implied volatility. But be aware of it. Over here, we have a lot of red UFOs order on a 55-minute chart. This means there are a lot of people who are actually placing the bear call spread, thinking price is not going to go above these levels, right? So a rally can be a short covering, yeah, and it's a correction, right? But when we go down, then the market crashes. So learning to make correct trading decision is really a part of the trading psychology, which is a process of the trial to error, right? So be aware of it that there's often a sympathy move. So let's say Microsoft could cause the Apple to move in the very same direction. So let's now just compare here Microsoft. Okay, so what did the Microsoft do on this particular chart? On Thursday, it opened higher and it closed where? Lower. If I now compare this to the Apple, I would see that what has happened with Apple, that it has opened, this is now higher, and then it sold off in a straight line down. Now, if I go over here on my previous setup that I have here, when I show the four things simultaneously, and I'm going to keep the QQQ, but I'm going to just alter it to daily. And down here, I'm going to put the Microsoft. You're going to observe that Microsoft and QQQ have moved in the same direction. But what about the Apple? On a daily, it has also moved on the same direction, right? So if you were on a smaller time frame, you would see this coordination, which is a broad market analysis. So no one in the right mind at that particular point should say, okay, let's look at the NVIDIA and go long on the NVIDIA if you know that all of these markets are going where? Down. So this is that thing that is called sympathy move, right? So be aware of it. Microsoft, Apple, NVIDIA are all part of the QQQ. And for you to analyze three different things, it's really time consuming. It's so much easier for you to look at the QQQ. Jeff just type in, is this likely to be filled today? Jeff, that particular trade that I sent, it's not going to get filled today, but Monday morning with all this market fluctuation, it's a very high chance that it's going to get filled. The only question is, are we going to get the price improvement, or are we going to get that limited to 21 cents? So knowing where these support and resistance levels are with the UFOs in conjunction with the trend lines that we need to draw is really important for us to know. So when I go over here back to my options with options, and I'm gonna go now here on the Twitter, because I know Mark has typed in the Twitter, because originally there was a lot of news about the Twitter. The price has gapped up initially on the news, and since then it has started going where? Down, right? So had we got filled on our original trade that we did, but we never got filled, the Twitter trade would have been profitable. Twitter trade would have been profitable because we had the bear pull spread. So really be aware of it, that if you are now about to trade Twitter, the trend line is creating the high, lower high, and another lower high, right? And then when you're looking at the UFOs, do we have a UFOs right above it, right? So now you have another trend line right here. So what we have here is what is called symmetrical triangle. Symmetrical triangle would mean equal chance that the price action can break to the upside, and equal chance that the price action is break to the downside. Then you need to ask yourself, from all the candidates that are existing right there, from all the candidates, is the Twitter really the best possible candidate to be traded right now that is currently in the news? No. Then it's actually easier for you to stick to going back to maybe trading again for products and continuously being familiar with them over and over again, because you're always looking at the four candidates. So looking at the Dow, looking at IWM, looking at the QQQ, looking at the SPY, instantly first thing in the morning, it gives you ability to look at it. Now, I want to finish up here with my absolute favorite time frame that I'm looking, and that is a 15-minute bar. 15-minute bar is very important first thing in the morning. And why is a 15-minute bar? It's important first thing in the morning, because then you can actually mark the line in the sand, and you're going to say to yourself, if we stay above the first 15-minute bar, then my bias should be to upside. If we lose the first 15-minute bar, then my bias is to the downside. Now, I will bring up FinViz here just to make the one point here before I dismiss you. And reason why I want to bring up the FinViz before I dismiss you, because this one thing that I want to leave you with today is concerning that bar that you can draw on even thin viz, because the thin viz shows 10-minute bars. So here's a thin viz, very much similar, only that I'm looking at four things. They excluded the Russell. I don't want to get into that, why they're excluding it. But the bottom line is over here. If I now look at this is a 10-minute bar, because over here we have a 10 minutes bar between a 9:30 to 10:30 Eastern. If you draw every morning a line in the sand like this, line in the sand after the first 15 minutes bar, okay, of course I'm doing here, you would get the good bias for the rest of the day. If all three of them are going lower, that's it. They're going lower. Now, could there be a reversal? Yeah, there are major reversal times, right? There's one at the close of the day around the 3:30, right? Well, there wasn't any major reversal at the 3:30 because price has gone where? It didn't go up. It actually continued going where? Down, down, and down. So anyway, the time is up. I'm going to now finish it. I really enjoyed this section on the trading psychology with you. I'm going to post in the notes in a few moments, and I wish you a good trading and have a good long weekend. Bye.